So the question is, how do we avoid this problem? How do we manage our income so that we don't pay unnecessary tax? Well, we need to learn what counts toward the calculation for provisional income, and then learn what does not count toward this calculation for provisional income. So the easiest way to highlight this is just to show you the different taxable buckets. See, on this side, you have everything that's taxed, and on this side, you have everything that's tax-free. Now, all your income from work, your pensions, your 401ks, growth from stocks, brokerage accounts, and 1/2 of your Social Security all come together to count as provisional income. All income from those sources have the potential to be taxed. Now, the sources of income that are not taxed are Roth IRAs, municipal bonds, and life insurance. Each one of these asset classes have the potential to be tax-free upon distribution or access of the funds there. So if you're following me correctly, the key to managing tax in retirement is making sure you have the right amount of money in each account. Too much money in accounts that count toward provisional income could cause you to pay tax. On the other hand, if you can maneuver that money to the accounts that are tax-free, then you can control your income in retirement and you can make sure that you're not paying any unnecessary tax. Now, for the remainder of this video, we're going to focus on the assets that are tax-free. We mentioned 3. We'll focus on 2 of them, the 2 most popular ones, Roth IRAs and life insurance. Now, the Roth IRA allows you to contribute after tax dollars. And while there are no current year tax benefits to your Roth IRA, your contributions and earnings can grow tax-free, and you can withdraw them completely tax-free and penalty-free as long as you follow the IRS rules. And the IRS basically states you have to leave the money in the account for at least 5 years, and you have to be age 59.5 to access those funds. If you meet those 2 rules, then all of the money you put into your Roth, as well as the growth, can be accessed completely tax-free. Now, there is no contribution age restrictions, meaning that you can be as old as you want to be. And as long as you have income, you can put money into a Roth IRA. They'll never say you're too old to make a contribution. As I already stated, your access is limited in your account until you reach age 59.5. You can withdraw all the money that you put into the account tax-free, but if you need to access your growth, the money you've made inside the account, then you could be charged a penalty if you access that before retirement. And they would also require you to pay tax on the money that you've made. Now, there are some exceptions to this rule. For example, if you're a first-time home buyer, you could get some access to your account, and there are other rules that allow you access. Another nice benefit of the Roth IRA is that there is no required minimum distribution. See, RMDs, as they are also called, are a required distribution that the government asks you to take once you get to a certain age because they want the tax revenue. But because Roth IRAs are tax-free, there's no requirement to take money. This allows your savings to continue to grow during retirement. And if you desire to leave some of those assets to your children, you can do so. There are no income taxes for inherited Roth IRAs. If you pass this Roth IRA on to your heirs, their withdrawals will also be income tax-free. Now, how much can you put into a Roth IRA? Well, the maximum amount that you can put into a Roth IRA in the year 2022 is $6,000. If you're under the age of 50, if you're over the age of 50, you can put $7,000 into a Roth IRA. If your income is over a certain amount, they limit your ability to contribute to a Roth IRA. Once again, once a person makes too much money, then they do not want you to be able to experience those tax benefits. The amount you contribute is slowly reduced until you can no longer put money into the Roth IRA. Now, another thing to be familiar with is depending on the way you file your taxes, you could disqualify yourself from a Roth IRA. I was working with a client, and for personal reasons, they had to file their taxes married, filing separately. And as a result, they couldn't fund a Roth IRA. Once you make over $10,000 in that situation, you can no longer put money into a Roth IRA. But that only applies to that unique tax filing.